It has been a buzzing week for commodities, be it crude oil, precious metals or base metal. The prices have seen a sharp surge on the back of increasing demand. At a time when the stock market rally has hit a pause and investors are worried about stretched valuations, is this the right time to bet on commodities? Hello and welcome to Commodity Champions Talk Back. I am Manisha Gupta and joining me on the show is Jonathan Bharat, CEO at bharatsbulletin.com. Feroz Aziz is Deputy CEO at Anand Rathi Financial Services. We also have with us Kunal Shah, Head of Commodities and Currencies at Nirmal Bang Commodities. Gentlemen, hi. Thank you so much for joining us on the show. In the next half hour, we will dissect the commodity rally and also answer all of your queries. All you have to do is tweet your queries to us with hashtag AskCNBCTV18 and we'll try to answer as many as we can. Jonathan, let me start with you first. And what a rally it had been for the equity markets, but with the valuations looking stretched, would you say that commodities perhaps is now the time to get in, especially to make money, to invest and to hedge equities as well, perhaps?
I generally think we've seen a pretty good, strong rally in commodities, there's no doubt about it, particularly over the last quarter. When you look across the whole spectrum, they've been quite solid. I think in any sort of form of rally, if the rally and the economics are sustainable, that should also keep the commodity rally also sustainable. So I guess when I look at it, I think at the end of the day, any dip that we see is only going to be supportive of a commodity rally that will extend.
Jonathan, if I had to tell you to pick your best pick when it comes to the metal space, whether it's precious or base metals, what would you want to take a look on?
Well, if I look at all of them, if I look at the entire spectrum, obviously I like the gold, silver, the precious metals. If I look at the base metals, then I still continue to support aluminium because I think at the end of the day, good economics there. We've had a lot of supply that's been cut out of the market, and we've seen quite an aggressive rally to the top side. Now, hopefully that rally wasn't just a short covering rally. I see more behind it, and at the end of the day, if I really see what's moving along, particularly in China, in terms of production cars, for instance, then I continue to see that supportive. So if I looked at the base metals, aluminium would be the major one.
Feroz, let me get into the conversation as well. What a run-up that we've seen in equity markets, global and Indian. All-time highs is what we kept making here. What has been your sense when you look at equities and when you look at commodities? Do you think this is the time to start hedging into the space?
I think, of course, like you rightly pointed out, this calendar year especially, we have seen large rallies, especially in the equities and also in the mid-cap space. So valuations like it has been marginally stretched. But fortunately, equities have a larger spectrum. So if you're getting more stock selective, then making money from here on also is possible. But having said which, hedging using commodities could be a very prudent thing to do at this stage, especially when you have some degree of inflows, which has triggered the domestic inflows, which has triggered valuations almost from a average perspective 30% more than averages if you look at any parameter of measurement on valuation. So point one is use commodities from a hedging perspective. In fact, from a hedging perspective, you can also use long-term derivatives in the equity, which are relatively unused on National Stock Exchange to hedge your equity bets as well and be more prudent and want to cut the rough edges of this journey.
Feroz, I also want to talk to you about the kind of, related views that we have seen between the commodity and the commodity stocks. Just to give an example, if the aluminum prices are up by 20%, Hindalco, of course, has given you much higher than that. Even a Tata Steel or an ArcelorMittal, I mean, if you could make those bridges there, the commodity equities tend to do much higher than commodities itself. So how would you look at the underlying commodity and the commodity stock, and how would you hedge the two together?
I think it's a very valid point. What happens is, if you're looking at the underlying commodity and then the stock which operates over it, you see a beta of almost about 2 to 2.5 times. By which I mean, if there's a fall in the commodity by 2%, there's a fall of 4-5% on the stock and vice versa. So, and in certain situations, when you're looking at larger, steeper moves, this beta actually stretches to 3.5. So stocks are going to be far more riskier than the commodity itself. To hedge it, you will have to make sure that if you go long on a stock which is high beta, ideally, to hedge it, I would go short on the commodity so that I just get the differential beta between the two. I think it's a very important play which needs to be watched if you're actually taking a commodity-driven stock and also you get a commodity exposure. So go long on the stock, for example, and then go short on the commodity and vice versa if you want to take benefit of this higher beta of the stock.
Well, that point is well taken, but we have a Twitter user, Manoj, now asking us for an outlook on gold and silver for the near term. Kunal Shah, would you want to take that on? What is your sense? Because we have seen prices run up quite a bit. Gold and silver, both the commodities trading at a 2-month highs. How would you want to look at the prices from here on?
I believe that gold and silver prices are not likely to move up exponentially unless there is a major geopolitical conflict between US and North Korea. But I believe that next week we are going to see some profit taking coming in gold. So I am of the view that from here the upside is going to be not very sharp going forward. But the broad call for gold, considering what is happening on the geopolitical front, still remain very bullish. So we are very bullish on the bullions for next year, more bullish than this year. So I believe that whatever downside you see during this year in bullions, capitalize that and buy it from the investment perspective. I think next year is going to be the year of bullion. So gold and silver likely to outperform the way it did in 2007-8. The similar kind of scenario we can see next year. And this year, the maximum downside for gold should be somewhere at 1220, 1230 when US raises rates. At that time, it can correct. And for the short term, I don't expect gold to go down below 1265 to 1260. So the view as of now is not to buy now, wait for a correction next week. Once this geopolitical crisis moderates a bit, you are going to see a tad lower prices, and then I think perhaps that will be again good levels to go along.
Well, another query also is in gold, and that of course is a favorite when it comes to Indian investors, whether it is investors or hedgers or housewives. Another Twitter user, Ismail, is asking if the gold prices can surge in the coming days. Kunal, if you want to take that up on as well. I mean, you said that the prices are not expected to run up too much from here on, but bring in the rupee calculation as well. And because of the rupee movement, we have seen the gold and silver prices, commodity prices in the Indian markets move accordingly. So how would you look at the Indian prices now? Because we're holding around those 29,000 levels.
Yeah, they are holding around 29,000. I think that 29,300, 400 should be it for the time being. The reason for that is that the upside, the depreciation in rupee is also likely to be limited. We are not going to see rupee back at 66, 67. We are not in that scenario. And apart from that, we believe that any positive news from the geopolitical front, North Korea showing intention to talk with US or some solution coming out on the table, there is a talk going on. At that time, gold and silver can correct. So 200-300 rupees upside from here in gold, book profits, wait for the downside and again re-enter.
I would want to bring in Jonathan as well on the same. Jonathan, hi, you heard Kunal. What is your sense on the gold gains? It clearly has been back in favor. We've seen good gains in the last 1 week, last 1 month as well. How are you looking at the technical and the fundamental picture?
Well, I think with gold, it sort of shows that resilience and that support on the downside. And every time it gets down to this level, we find we have a good lift. Whether it's geopolitical, whether it's dollar-orientated, or whether it's just purely technical, I think gold is slowly coming back into favour with a lot of investors.
Jonathan, there always is this debate about whether it should be gold or silver, because silver always has given better returns on the higher side and the downside as well. Are you picking silver over gold?
Look, I think you can have a bit of both, to tell you the truth, but silver hasn't really moved. And I think around about the 17, well, certainly around $16.50 to $17, you know, it makes very good value. And I can actually see it having a good, strong rally up through that 2025. But I think if I were to do anything, I think I would favour silver over gold, but I like both the metals.
Jonathan, while Feroz and Kunal both have spoken on gold and relative aspects around it, what is your sense? If somebody was buying gold now, how much of an upside, what kind of a timeline then would you be advising?
I think, and part of our funds have moved back into the metal just over the last 48 hours. So we're quite bullish. We are looking for some good runs to the top side. I think the time horizon at the moment could be longer than we actually normally think. Because it's actually broken through some significant trendline resistance, we feel that this rally could be sustainable for the next couple of weeks. Now, what sort of targets would we see? I think for gold, you can look at 1320, maybe even a little bit higher than that. I think for silver, you can look at around that 20, 25, maybe even $28 an ounce. So I think there's more upside in both of them, and I think they're the targets which we're certainly aiming for at the moment.
Well, those are bullish targets coming in from you, Jonathan. But what would you advise? How much should gold be in one's portfolio if you have your money assigned to equities, to derivatives, to land? How much would you want to put in gold?
Look, I think most people would normally put around about a 5% weighting to the precious metal. But I think you can go a little bit higher than that now. And I think you could probably move up to around about that 10%, maybe even a touch more than that, because I do feel that once gold comes into favour again, you'll get good support not only from the ETF market, the investment community market, but also the hedge market. So I think that you can certainly increase your weighting, probably double it, move a little bit away from equities in some areas, in particular some sectors of the equity markets, and move back into the precious metal market.
Well, yes, 5% has been well said. But Feroz, getting you in the conversation, what is your sense? How much gold should be a part of your portfolio? 5% to 10% is what most people say. Mark Faber said 25%. JPM said they are increasing their number there as well.
See, in my opinion, anything which has to hedge has to have a strong weightage. If it's 5 to 10%, any 5 to 10% does not have the capacity to hedge a 50-60% part of the portfolio meaningfully. If you're taking the gold route and the precious metal route to actually bring some stability to the portfolio, then it should ideally be in the 15-20% range at least, so that it can almost shoulder the responsibility of bringing stability to an equal quantum in the equity side. So I would vouch for something between 15 to 25%, like you illustrated. I think that would be a more sensible number if hedge is the primary criteria and stability, and it being an anchor to your portfolio.
Well, that point is a number is well taken, Feroz. But we also have one more Twitter query now coming in from CJV555 is the Twitter handle. And he asks on crude, he's asking for a price target for the next 10 to 15 days. Kunal, would you want to come in for that? Because the Indian markets clearly have seen nearly a 7% gain in the crude oil prices. That has been the kind of gain that we saw in the global markets for the Brent prices also. How are you looking on that on charts?
Yeah, we've seen a humongous rally in oil from $42, almost $50 on the upside, what we've seen. From last 3 weeks, we are continuously observing US inventory is coming down, and sharp draws what we are observing in oil. And apart from that, one of the major reasons we believe that oil is not going to crash is what OPEC has committed. OPEC is strictly complying with the production cuts, and US rig counts are not moving up sharply. So there is a strong case that WTI can definitely breach $50 on the upside. So I recommend that on Indian basis around 3050, 3070 on the correction, one should go long in oil for the upside target of 30 to 50.
Jonathan, coming back to you as well, while the rally has been tremendous, also if we look from the kind of lows that we recently made, as Kunal mentioned, we are just a couple of percentage points away from an official bullish territory because crude is back 17% from recent lows. Are you looking at crude prices gaining much from here?
Well, I guess when I'm looking at crude, I'm particularly looking at what OPEC did in terms of its compliance. Saudi Arabia coming out and saying that it certainly wants those supply cuts to continue. And also we've seen, obviously, OPEC wanting Nigeria and Libya, or particularly now so Libya, to actually put some of those supply cuts as well. Remember, they've also reached close to their capacity. So I think at the end of the day, when I look at the oil market, even with these supply cuts looking through, we're seeing the oil market under pressure. Now, what does concern me is the fact that we move away from the drive time, summer drive time in the States, and with that result, we see less demand for them and a glut to come back online. So, in my mind, very hard to trade at the moment with the oil market, but my bias is towards the downside.
Okay. How much of a downside would you see then? Because I understand, as you pointed out, there are various moving pieces here, from OPEC to compliance to shale output, and of course geopolitical tensions as we see happening, North Korea, US, sanctions on Russia, Venezuela. There is just too much to watch out for when you look at crude oil prices.
Well, I mean, as you know, oil has been trading in this quite lethargic range for some time, and it's been stuck in here. So I think when you look at it, you go head back down to that $45 a barrel, see what happens. I don't actually feel it can get too much lower than that.
All right, so 45 to 55 is the range that can perhaps continue in case of the crude oil prices. Well, we've addressed your queries on gold, silver and crude. It's time to take a short break, but we will talk about more commodities, rally and answer your questions on the other side.